Hi, everyone. My name is Salman Ahmed. I'm the Global Head of Macro and Strategic Asset Allocation at Fidelity International. And today we are going to speak about the outlook for 2021 for developed market equities. It's an extraordinary and completely abnormal period, both from a macro perspective and from a markets perspective. And we do need a new flight plan. And that is some of the thoughts I would like to share with you today in our presentation. So moving to the next slide, this is how we are looking at this new abnormal. There is fiscal dominance coming, especially in the US. Please remember that the plans the Biden administrations have put forward amount to another 15 to 17 percentage points of fiscal easing. So fiscal policy is taking over for monetary policy. Then there are testing times ahead for central banks, which continue to provide massive easing as the growth upswing arrives. And then what are the investment implications? In developed market equities, it's earnings-driven rotation, and something which we will discuss a little bit later, liquidity, policy, and then the interplay between valuations across these different dimensions. Now, if I show you the next picture, to give you a medium-term to a long-term backdrop to this environment, this is debt. Very, very high debt ratios, and it's probably going to be the pandemic shock's most important macro legacy. Let's not forget that debt ratios in the developed world are now surpassing World War II levels. And if you look at the different countries, it's the same trend which has been in place since 2008. However, this debt accumulation has been made sustainable by these very, very easy central bank policies. And as fiscal policy comes through, we think that it will have major implications in terms of the beneficiaries and the losers coming out of developed market equities. And let me show you in the next slide what we are thinking about that. So 2021, given this context, we think is a year of rotation into reflation and proper strong reflation. Again, driven by this very strong fiscal policy impulse where the governments will be spending money and the central banks will be making sure that this heavy debt loads remain sustainable. And if we look at the different sectors, we think that traditionally those sectors who have come under pressure due to the COVID shock have a strong likelihood to do better going forward, especially as deflation comes through. So that is value, consumer discretionary, airlines, and cyclicals. So a lot of differentiation for us to think about as we move forward in 2021. If I show you the next picture on styles as we are looking through in developed market equities, the value versus growth debate has once again been very, very important and has become very topical. There's no doubt that, especially in the US, that we have a serious concentration issue as the largest stocks are making up more than 20% of the market, which was actually a bit higher than what we saw at the last dot-com bubble years. That said, the value underperformance also has been very, very extreme. And with this backdrop of macro, which I shared with you, which is completely abnormal because we have not seen such fiscal policy come into play since the World War II years. And on top of that, a different role of central banks also playing up, we think that value underperformance has room to reverse to a certain extent as we move through 2021 and beyond. Let me go a little bit bottom up, where we rely on our bottom up analysts' earning assessments, which I show you on the next slide, whereby they come up with their strong assessment of different sectors as bottom up numbers are aggregated up to the sector level. And what we see once again is that some of the cyclical sectors, which came under a lot of pressure in 2021, in last year in 2020, have strong upside potential. So if you look at industrials, even if you look at energy, if you look at financials, in 2021, we think that earnings can really become turbocharged in these sectors as the reopening themes comes through and fiscal policy starts to support actual spending, which benefits some of these real economy sectors. Now, let me end by key macro and market risks for 2021. So the optimism we saw in the later end of 2020 has carried over so far to 2021, but we do need some reality checks. The most important risk, top of our mind right now, where we are spending a lot of time analyzing and developing multiple toolkits, is to understand the continued credibility of central bank policies. We expect challenges, we expect tantrums, but at the end, we do think that the central banks have additional ammunition left to make sure that this very, very high debt burdens remain sustainable. Then there are risks coming from the vaccination timeline delays. There potentially could be supply and demand challenges which could grow. We need to monitor them very, very carefully. There's a lot of heterogeneity also, or differentiation within countries happening at the moment. For example, UK is far ahead of other developed markets at the moment in terms of vaccination. So that has to be taken into account as well. And then we have got virus mutation, which is a very important risk. We saw some of this risk factor become live at the end of last year and early in 2021. And if another mutation happens, which really affects the effectiveness of the vaccines, then there is another source of uncertainty we may have to deal with. Last but not the least, on the medium-term perspective, is the US-China decoupling. We know that we are in an era of great competition between these two economic superpowers, and this is not only going to stop here, but only going to accelerate even after the change in the administration at the White House. And I would end my comments by looking at the markets and going back to the markets. And here we have to be careful that valuations in some parts of the markets are flashing red. So there are signs of expensive and frothy valuation in some parts of the markets. But we are right now focused on the beneficiaries of this policy impulse and where valuations are more supportive and are a source of tailwind. But we have to be careful about leverage and behavior patterns in some markets, as we saw with the changing behavior of retail when it came to some specific stocks recently in the US. So lots to chew on, but the key message we want to share with you is that this is an abnormal period, and the way we look at developed market equities will have to change as well. Thank you very much for your time.